The Monetary Authority of Singapore has raised its 2026 inflation forecast to 1 to 2%, up 0.5 percentage points previously, to reflect rising wages and stronger domestic demand. Still, it's kept monetary policy settings unchanged for the third straight review, citing economic resilience supported by AI-driven growth. Ivy Chalk with this report.
Stronger consumer spending and higher labour costs for services. These are factors MAS says could lead to inflation ticking up slightly in the coming months, even as global food and oil prices ease.
In particular, I think they are starting to see some signs of tightness in the domestic labour market. And, given that, 1 in 4 employers now expect to hike wages and that, there's, that wage growth probably will underpin also, consumer confidence and in turn, private consumption.
Despite inflationary pressures, Singapore's economy is expected to remain resilient in the near term. That's amid a global AI investment boom, driving up demand for Singapore-made memory chips essential for storing large datasets. Still, one analyst says he's mindful of potential potholes.
Financial markets, particularly the equity markets in the US, have been quite exuberant over the AI boom, given the very strong rally. And disorderly and correction could hurt sentiment and investor confidence towards the AI boom. And if this risk were to happen, that could disrupt the investment cycle and demand for AI-related products.
Meantime, non-tech segments could help drive growth. For instance, the construction industry continues to see a steady pipeline, underpinned by mega long-term projects like Changi Airport's Terminal 5 and Tuas Port. Other sectors are showing resilience as well.
We have like BTS and some of the other concerts, the high-profile concerts that are coming to Singapore as well. So I think that should kind of like make sure that visitor arrivals to Singapore remains healthy.
Financial services will continue to benefit from accommodative financial conditions, so meaning lower interest rates supporting credit growth, as well as the equity markets being supported by some of the reform measures that MAS has undertaken.
Overall, while MAS says full-year GDP growth in 2026 is expected to slow from 2025, it's monitoring economic developments closely to respond to any inflation risks.
Hiring is expected to be more cautious in the first quarter of this year, with a slight dip in the proportion of firms planning to hire in the next 3 months. Still, according to the Manpower Ministry's advanced labour estimates, the job market is expected to continue expanding and remain tight. The finance and health services sectors boosted employment growth last year. Unemployment also remained low at 2% overall. But retrenchments rose slightly to 14,400, higher than the near 13,000 the previous year, though MOM says it remains around the pre-recessionary average. The rise was mainly from the transportation and storage sector, driven by business reorganization and restructuring. Despite these shifts, analysts remain cautiously optimistic about the year ahead.
In 2025, I feel that the hiring is a bit more fragmented, right? In 2026, as we come into the year, where you see semiconductor and a few other industries, as they start to turn around, we are quite hopeful that 2026, there will be a lot more jobs out there, also because of the job creation of based on AI.
Emerging opportunities in the AI sectors are also expected to create new roles, though experts caution that the uncertain economic outlook could influence hiring decisions.
Challenges will be what will happen to the hiring pressures that the companies will face this year because of external factors. That could be, think about again, how trade will affect Singapore. There could be factors that Singapore is getting into these free trade zones with Malaysia, with Vietnam, how that will affect hiring and how that will affect wages. And there could be other restructuring that may be happening in the industry.
Assistant Secretary General for NTUC, Yeo Wan Ling, says that retrenchments aren't broad-based, but in a rapidly transforming environment, it's even more important to provide early support for workers to adapt and reskill. To that end, the labour movement has enhanced its career coaching, job matching and training pathways to strengthen employability. It will also call for stronger support for workers in the upcoming budget. So what do these reports mean for jobs, prices and the outlook ahead? For more, we speak to Barnabas Gan, who is a Group Chief Economist at RHB Bank. Barnabas, great to have you with us. Now, we hear that MAS is saying that inflation is picking up. So which categories of goods and services do you think are likely to see the biggest price pressures?
Thank you for the question. I think before I answer that, let me just be very clear that inflation pressures are very manageable and tame, and it's expected to be so into the coming year. But the thing is that increased prices have generally been seen across the many years, so it shouldn't be taken off, and we shouldn't be too worried about price pressures because it's been seen across many years before. But probably the few key sectors that we will likely see higher prices probably is food. I do recall that the coffee shop downstairs my place have increased prices already, so that's one. But secondly, with the lower oil prices that we have seen in 2025, that may mean a prospect of higher prices in this year, and that could actually lift energy prices in Singapore. This is accounting for the increased geopolitical tensions in the Middle East, and that could have upside bias for energy prices. The last bit probably is retail. With Chinese New Year and Hari Raya, up in the next season, in the next month to come, probably the increased consumer demand might mean higher prices, especially for the retail sector.
Now let's talk a bit about jobs. Do you think wage pressures could lead to slower hiring or maybe more selective hiring freezes when it comes to 2026?
Yeah, so that's the thing, you see, because I don't fully agree with the wage pressures leading to softer hiring behavior in Singapore. It's like a chicken and egg kind of thing, Will increase hiring lift wages, or will increase wages limit hiring? So I would believe that it is a free market in terms of the labour market, whereby an increase in labour demand should necessitate higher wages, so that should be the right direction of argument. But probably, I think into the year ahead, I fully agree that the job market still remains to be quite tight in Singapore. At 2% is to die for, compared to the rest of the ASEAN economies. So essentially, if the job market still remains tight, then that could mean that the continued growth of the Singapore economy at 3% from where we stand for this year would mean that the job markets will remain to be in demand, and the labour supply, be it limited, will just mean that wages will continue to grow.
And speaking of that growth as well, with tech-related sectors, that's growing, but then the hiring there also appears to be more restrained. So what does that tell us when it comes to job prospects in the tech sector specifically?
So the tech sector is something that probably needs a little bit more argument here. Why? Because even if, and that's a fact that even if I am most optimistic on the tech sector, which I am, I'm also most cautious on the tech sector, simply because of the fact that the tech sector or the AI boom will be the one that will likely drive the recruitment in the labour demand in the tech sector and the overall growth in this sector itself. But generally, the talk of the market really is that the AI boom is something to watch for. If there's circular investments within the AI space, and that could mean that a bubble is forming, and that would be one of the risks that probably investors and analysts like myself are watching very closely.
Yeah, and speaking of risks as well, both MAS and MOM have warned about these risks.
Indeed,
you mentioned the possible AI bubble, also global shocks. That's another risk that has been highlighted. Now, in simple terms, what should we be watching out for when it comes to the consequences of these potential risks?
So, being an economist and an analyst and a statistician at heart, we do have tools, in fact, from a statistical point of view to argue for or against a bubble. And the consolation is that with the tools at hand, there is evidence that the current AI surge hasn't been identified or defined as a bubble yet because of if we compare this with, say, the past bubbles, such as the housing bubble in the US as well as the dot-com bust, we are not there yet. But however, the bubble, it's brewing in the sense that if it continues to grow beyond what the normal rate of growth is going to be based on the model itself, then a bubble may be forming. Not bubble yet, that's the point. And probably we have to watch closely, and if I could criticize myself, so to speak, a bubble will only be accurately identified on hindsight. So that's the risk that probably we all look at.
Yeah. Well, do you also think that the steady appreciation of the Singapore dollar will effectively moderate inflation?
Yeah.
Is there the possibility, or do you think there are other policy tools that might be needed here?
So it is a fact, and it is a well-known understanding, and it's empirically proven that the Singapore monetary policy, which is a Singapore near band, has been very effective in controlling inflation, simply because of the structure of Singapore being a small and open economy, and for the fact that we import most of our necessities from overseas. So the stronger Sing dollar, which we are seeing, based on the MAS policy, has been in history very effective in controlling imported inflation.
Now, Barnabas, thank you so much for sharing your analysis with us. I've been chatting with Barnabas Gan, who is a Group Chief Economist at RHB Bank.